Before we begin, please remember that I am not a licensed financial advisor or insurance professional. This video is for informational and entertainment purposes only. The strategies discussed are based on my own research and experience, but they are not guaranteed to produce specific results. You should always consult with a qualified professional and conduct your own due diligence before making any financial decisions. Your insurance needs are unique, and what works for one person may not work for you. You get the email, or maybe it's that crisp, formal envelope in the mail. You know the one. It's from your car insurance company. You open it, your eyes scanning past the corporate logo and the friendly-sounding letter, straight to the number, the premium, and your heart sinks. It went up. Again. For no reason. You haven't had an accident. You haven't gotten a single ticket. You haven't even changed your car. So why are you being asked to pay an extra $300, $400, maybe even $500 this year for the exact same coverage you had last year? You feel that familiar sting of frustration, of being trapped. You need car insurance, it's the law. But it feels like you're being taken for a ride by the very company that's supposed to protect you on the road. If that sounds familiar, you are not alone. And I'm here to tell you that it's not your fault, but it is your problem. The average American driver overpays for car insurance by an estimated $400 every single year. For some, that number is well over $1,000. That's a vacation. That's a new laptop. That's a significant chunk of your emergency fund, just vanishing into the pockets of a multi-billion-dollar industry that has mastered the art of making you pay more than you should. They are counting on your confusion. They are banking on your loyalty. And they are profiting from your inaction. But that ends today. In this presentation, I am going to pull back the curtain and expose the 5 most effective, insider strategies to find dramatically cheaper car insurance quotes in America. These aren't the generic, useless tips you've heard 1,000 times like drive safely or raise your deductible. No, these are the real actionable secrets the insurance industry hopes you never, ever figure out. We're going to dismantle their playbook piece by piece, so you can stop being a victim of their pricing games and start being a savvy consumer who keeps more of your own hard-earned money. By the end of this, you will have a clear step-by-step blueprint to slash your premium, and you will never look at that renewal notice with a sense of dread again. Instead, you'll see it as an opportunity, a game you finally know how to win. I know this because I used to be on the other side. For years, I was the ideal customer. I stuck with the same big-name insurance company for almost a decade. I paid my bill on time every time. I thought my loyalty meant something. I thought they'd reward me. What a fool I was. My reward was a series of rate adjustments and regional increases that slowly but surely bled my bank account dry. The final straw was a renewal quote that was 40% higher than what I paid just 3 years earlier, with a perfectly clean driving record. I'd had enough. I spent the next 6 months obsessively researching, talking to industry insiders, reading through dense policy documents, and testing every strategy one could find. I treated it like a mission, and what I discovered was shocking. The entire system is built on a foundation of psychological tricks and data models designed to extract the maximum amount of cash from the most loyal customers. But here's the good news. Their system has weaknesses, big ones, and we're going to exploit every single one of them. So get ready. We're going to cover the digital breadcrumbs you're leaving online that insurers use to price you out, and how to erase them. We're going to reveal the one simple question you can ask your current agent that can sometimes lead to an instant discount. And we're going to talk about why the way most people compare quotes is fundamentally flawed and practically designed to make you overpay. But we have to start with the single most important concept, the bedrock of their entire profit model. It's the reason your rates go up for no reason. It's a sneaky, unethical, but perfectly legal practice known as the loyalty penalty. This is our first smart way to get cheaper insurance. Understanding and defeating the loyalty penalty. So what is it? In any other industry, loyalty is rewarded. Your favorite coffee shop gives you a punch card for a free drink. Airlines give you frequent flyer miles. But in the world of car insurance, loyalty is often punished. Insurance companies have a term for it. They call it price optimization. It's a fancy way of saying they use sophisticated computer algorithms to figure out which customers are least likely to shop around for a better deal. And if the algorithm flags you as a sticky or inattentive customer, it will systematically raise your rates year after year, bit by bit. They are betting that the increase won't be quite large enough to make you go through the hassle of switching. They're squeezing you slowly. Think about it. Who are the most loyal customers? Typically, it's older drivers who have been with a company for decades, or busy parents and professionals who simply don't have the time or energy to fill out a dozen different quote forms. The insurance companies know this. Their data tells them exactly who you are. They know your age, your credit history, how long you've been with them, and even how often you log into your online account. They use all of this to build a profile and predict your behavior. If you fit the profile of someone who just sighs and pays the bill, congratulations, you've just been identified as a prime target for the loyalty penalty. When I got that outrageous renewal notice, I called my company, ready for a fight. I said, "I have a perfect record. Why did my rate jump up by over $400? The agent on the other end gave me the classic pre-rehearsed line. "Well, sir, our costs have gone up, and we've had to implement a general rate increase for all customers in your area." That is a half-truth designed to shut you down. While it's true that rates can increase across a region due to more accidents or higher repair costs, that rarely accounts for the entire increase. The unspoken part of that sentence is, "And our data shows you probably won't leave us, so we've added an extra 10, 15, or even 20% on top of the general increase just for you, because we think we can get away with it." It is a calculated gamble. They are literally betting against you. They are betting that your loyalty or your inertia is worth more to you than $300 or $400. For millions of Americans, the insurance companies win that bet every single year. But they are not going to win it with you. Not anymore. Understanding that this is happening is the first crucial step to taking back control. You have to shift your mindset. You must stop thinking of your insurance company as a trusted partner and start thinking of them as a service provider you reevaluate every single year, with zero emotion and zero misplaced loyalty. Your goal is to get the best possible coverage for the lowest possible price, period. Their goal is to get the most possible profit from you. These two goals are in direct conflict. So how do you fight back? How do you signal to their algorithms that you are not a sticky customer? How do you turn this entire system on its head? It starts with a simple but powerful strategy that I call the annual reset. It's a process you must commit to doing every single year, about 45 days before your policy is set to renew. And the very first step in this process involves collecting a specific set of documents and understanding a key piece of information on your current policy that 90% of people ignore, but it's the secret key to getting truly comparable apples-to-apples quotes from other companies. This is the foundation for everything. Making a mistake here can sabotage your efforts before you even begin, leading you to believe your current rate is good when it's actually terrible. So how do you break out of that trap? How do you stop comparing your rate against one or two other potentially terrible rates and actually see what the entire market has to offer? This brings us to the very first and arguably the most impactful smart way to find cheaper car insurance. You have to stop shopping like it's 1995 and start shopping like it's today. I call this the difference between the shotgun method and the sniper method. Let's talk about the shotgun method first because it's what most people still do, and it's a masterclass in wasted time and missed savings. This is the old school approach. You decide you're going to shop for insurance. So you sit down, maybe you pull up Google, and you type in a big famous insurance company. You know the ones. The ones with the talking lizards, the goofy commercials with the emus, or the guy in the red shirt named Jake. You go to their website and you begin the process. You enter your name, your address, your date of birth. You enter your vehicle's VIN number, your estimated annual mileage, your driving history. You answer questions about your job, your marital status, your credit score. 15, maybe 20 minutes later, you finally get a number. A single quote. Okay, one down. Now what? You go back to Google and you pick another household name. And you do it all over again. You enter your name, your address, your date of birth. The same exact information, typed into a slightly different set of boxes. Another 20 minutes gone. Another single quote. By this point, your motivation is already starting to wane. The process is tedious, it's repetitive, it's boring. But you push on. You do a third one. Maybe you even call a local agent you drive by every day. You spend another half hour on the phone, answering the same questions you just typed out twice. At the end of this hour-and-a-half ordeal, you have 3 quotes. And here's the psychological trap. You feel like you've accomplished something. You feel like you've done your due diligence. You compare the 3 numbers, maybe one of them is 10% cheaper than your current rate, and you think, great, I'll switch and save $150 a year. You pat yourself on the back and you move on. But what you've actually done is fired a shotgun in the dark. You've aimed at 3 of the biggest, most obvious targets in a forest filled with hundreds of them, and you've completely missed the vast majority of the opportunities. You've only seen a tiny, minuscule sliver of the actual market. The United States has over 300 major auto insurance carriers. 3 quotes isn't due diligence. It's a rounding error. You're basing a major financial decision on less than 1% of the available data. It's like wanting to find the best burger in New York City but only trying McDonald's, Burger King, and Wendy's. You're missing the real gems. This is where the sniper method comes in, and it changes the game completely. The sniper method is about using technology to do the heavy lifting for you. It's about maximum efficiency and maximum market exposure. Instead of you going to each company one by one, you go to one place that brings all the companies to you. I'm talking about using online insurance comparison platforms or working with a truly independent insurance agent. Think about how you book a flight. Do you go to American Airlines website, fill out all your info and get a price, then go to Delta's website and do it all again, then go to United's website and do it all again? Of course not. That would be insane. You go to Expedia or Kayak or Google Flights. You enter your information once and within seconds, you see prices from dozens of airlines, all laid out in front of you. You can instantly see who's the cheapest, who has the best layovers, and who's charging a fortune. This exact same technology exists for car insurance, yet a shocking number of people have no idea. These comparison websites are essentially digital insurance brokers. You go to their site, you fill out one comprehensive form. Yes, it will still take about 10 or 15 minutes because the details matter, but then you hit submit, and the magic happens. Their platform securely sends your information out to their network of dozens, sometimes over 100, different insurance carriers. And within minutes, you get a list of real bindable quotes from a huge range of companies, from the national giants to smaller regional players you've probably never even heard of. Now, a common question is, what's the catch? How are these sites free? It's simple. They work on the same model as a traditional insurance agent. If you choose to buy a policy from, say, Progressive through their platform, Progressive pays them a small commission. The key is that this commission is already built into the insurance company's pricing structure. It doesn't cost you a penny extra. In fact, it saves you money because it forces the insurance companies to compete for your business in a live, transparent marketplace. When they know you're simultaneously seeing a quote from their biggest rival, they have a powerful incentive to sharpen their pencil and give you their best possible rate right out of the gate. This approach is fundamentally superior for 3 critical reasons. First, as we've discussed, is market access. You might discover that a company called Erie Insurance or Auto Owners or PEMCO, companies that don't spend billions on Super Bowl ads, offers an identical policy to your current one for half the price. These companies often have some of the highest customer satisfaction ratings in the industry, but they can offer lower premiums because they have much lower overhead. You would likely never find them with the shotgun method. The second reason is what I call the algorithmic lottery. Every insurance company has its own secret, complex algorithm for calculating risk. It's a black box of data points. Company A's algorithm might heavily penalize drivers of red sports cars, while Company B's algorithm couldn't care less about the color, but despises drivers in a specific zip code. Company C might give huge discounts to married homeowners with excellent credit, while Company D offers its best rates to single renters with a PhD. The point is, you can never predict which company's algorithm is going to view you as the perfect, low-risk customer. Your profile might be a jackpot for one company and a dud for another. The only way to win the algorithmic lottery is to buy as many tickets as possible. Filling out one form on a comparison site is like buying 100 lottery tickets for the price of one. The third reason is leverage. When you call an agent who only works for one company, say State Farm, you have zero leverage. Their job is to sell you a State Farm policy. They can't offer you a better deal from Geico if Geico's rate is lower. But when you use a comparison tool, you hold all the power. You are the prize. You've created a bidding war for your business, and that dynamic fundamentally shifts the leverage from the seller to you, the buyer. So, the first smart way, the foundation of everything else we're going to talk about, is to adopt the sniper method. Your action item is this: find 2 or 3 of the major, reputable insurance comparison websites. I say 2 or 3 because not all of them have the same insurance carriers in their network, so using a few gives you even broader coverage. Spend the 15 minutes it takes to fill out their forms accurately. This single action will give you a more comprehensive and powerful view of your insurance options than 95% of drivers ever get. An alternative, if you prefer a human touch, is to find a good independent insurance agent. Not a captive agent who only works for one company, but a true independent broker who represents dozens of different carriers. They essentially do the same thing as the website, but you get to talk to a person who can offer advice. Either path, the digital tool or the human broker, is a massive upgrade over the old shotgun method. It replaces hours of frustrating, repetitive work with a single, efficient action that puts you in complete control. But here's the crucial next step, and it's where so many people who use these tools still go wrong. Getting a long list of quotes is just the first battle. Gets your foot in the door. But the number you see on that screen, that initial quote, is almost never the final, lowest price you can get. It's a starting point. The real, deep savings are hidden inside the details of the policy itself, in a series of discounts and adjustments that most people don't even know exist. Getting a cheap quote is good, but turning that cheap quote into an unbelievably great rate, that requires a different set of skills. And the most powerful of these is a strategy one called discount stacking. It's the secret weapon that separates the amateurs from the pros in the insurance game. Discount stacking is the art of layering multiple, smaller discounts on top of each other until they create one massive price drop. Think of it like this. One 5% discount doesn't feel like much. It's a cup of coffee. But when you stack a 5% discount on top of a 10% discount on top of another 5 and another 3, suddenly you're not just saving on a cup of coffee, you're saving enough for a week's worth of groceries. Insurance companies have dozens of these discounts available, but they don't always advertise them. Why? Because their business model relies on you paying the highest price you're willing to tolerate. They're not going to volunteer information that costs them money. Your job is to become a discount detective. You need to actively hunt for every single price break you're entitled to, and make sure it's applied to your policy. Most people get one or two of the obvious ones and stop there. We're going to go for all of them. Let's break these down into 3 main categories. First, discounts about you, the driver. Second, discounts about your CAR. And third, discounts about your policy itself. Let's start with you. The most well-known discount in this category is the good student discount. If you or a driver on your policy is a full-time high school or college student, usually under the age of 25, and maintains a B average or a 3.0 GPA, you can often get a significant discount, sometimes as much as 15 to 25%. This is a huge one, especially for parents with a teen driver on their policy, which is notoriously expensive. All you typically need to do is send in a copy of a recent report card or transcript. Here's a pro tip. Even if the student is away at college without a car, as long as they're still listed on the family policy for when they drive at home during breaks, the discount can still apply. Don't leave that money on the table. Next up is the defensive driving course discount. Insurance companies love customers who actively try to be safer drivers. By completing a state-approved defensive driving course, you prove that you're a lower risk. These courses are widely available online. They're not expensive, often just $20 or $30, and can usually be completed in a few hours from your couch. Once you pass, you get a certificate. You send that certificate to your insurance company, and they'll typically apply a discount of 5 to 10% that lasts for 3 years. The math here is a no-brainer. The money you save on your premium in the first year alone will almost certainly be more than the cost of the course. Everything after that is pure profit, and you actually become a better, more aware driver in the process. The king of all driver-based discounts, however, is the good driver or safe driver discount. This is your reward for being responsible on the road. The rules vary, but generally, if you've gone 3 to 5 years without any at-fault accidents, moving violations like speeding tickets or DUIs, you hit the jackpot. This can be one of the largest discounts available, sometimes knocking 20, 30, or even 40% off your premium. This isn't just about avoiding big mistakes. It's about consistent, boring, safe driving. This is the discount that makes your patience and good habits pay off, literally. Now let's move to the second category, discounts about your car. The vehicle you drive is a huge factor in your rate, and its features can be a goldmine for savings. The most common are the vehicle safety equipment discounts. Does your car have anti-lock brakes? That's a discount. Does it have airbags, especially side curtain or dual front airbags? That's a discount. Does it have daytime running lights? Believe it or not, that's often a small discount. One of the biggest in this subcategory is the anti-theft device discount. If your car has an alarm system, or better yet, a vehicle recovery system like LoJack, you're making it less likely to be stolen. For the insurance company, that means it's less likely they'll have to pay out a massive claim to replace your entire car. So they reward you. Go through your car's manual or look up its features online using the VIN number. Make a checklist of every single safety and anti-theft feature. Then when you're getting a quote, read that list to the agent. Don't assume their system automatically knows that your specific trim level came with an engine immobilizer. You have to tell them. Each one might only be a 1 to 3% discount, but this is discount stacking. They all add up. Finally, we have our third category. Discounts related to your policy and how you manage it. These are often the easiest to get because they're just a matter of clicking a few buttons. The first is the paid-in-full discount. Most people pay their car insurance monthly. Feels more manageable, but it's almost always more expensive. Insurance companies charge administrative fees, sometimes called installment fees, for the convenience of breaking up your payment. But if you can afford to pay your entire 6-month or 1-year premium all at once, they will reward you with a hefty discount. Why? Because it's guaranteed money for them. They don't have to worry about you missing a payment, and it cuts down on their billing costs. Think about it. If your premium is $1,500 a year, and they charge you an extra $10 a month for installments, that's $120 a year in fees. That's an 8% interest rate you're paying for the privilege of splitting up your bill. Pay in full and pocket that cash yourself. Next are the simple administrative discounts. Autopay and paperless billing. These are small, but they're effortless. By signing up to have your payments automatically deducted from your bank account, you're saving the company the risk of a late payment. That's worth a few bucks off your bill. By agreeing to receive all your documents via email instead of snail mail, you're saving them money on paper, printing, and postage. Again, they'll shave a little bit off your premium for that. It might only be a $5 or $10 discount per policy period, but remember the rule. We stack everything. Let's see how this works in the real world. Meet Alex. Alex is a 22-year-old college student with a 3.5 GPA and a 2019 Toyota Camry. His initial quote is an eye-watering $2,200 a year. It's painful, but Alex has been watching this video. First, he sends in his transcript. Boom! The good student discount knocks 15% off. The price drops to $1,870. Then he spends a Saturday afternoon and $25 to complete an online defensive driving course. He sends in the certificate. Wham! Another 10% comes off the new total. Now he's at $1,683. He looks up his car's specs and realizes it has an anti-theft engine immobilizer and daytime running lights. He calls the insurance company and makes sure they're listed on his policy. That's another 5% combined. The price falls to $1,598. Finally, he realizes he can use some of his savings to pay the whole 6-month premium upfront instead of monthly. He also signs up for autopay and paperless billing. The paid-in-full and administrative discounts chop off another 10%. His final yearly premium is now $1,438. By strategically stacking 5 different discounts, Alex just saved himself over $760 a year. He went from a painful quote to a manageable one, not by changing who he is or what he drives, but simply by being a savvy consumer and asking for the discounts he was already entitled to. That is the power of discount stacking. It's not about one magic bullet. It's about a dozen small smart moves that add up to a massive win. But these are just the standard discounts that are available to almost everyone. What if I told you that your profession, your marital status, and even whether you own a home could unlock an entirely different tier of savings? These are the deep-cut discounts, the ones that are often bundled together for even greater effect, and they can transform a good rate into an unbeatable one. And that's exactly where we're going next. So let's talk about the art of discount stacking. This isn't just about finding 1 or 2 price breaks. This is about strategically layering them, one on top of the other, until the original quote is almost unrecognizable. Think of it less like a checklist and more like building a masterpiece of savings. Each discount is a brushstroke, and when you combine them, the final picture is a premium that's a fraction of what most people pay. We start with the foundation, the discounts that are often the easiest to get but are shockingly easy to miss. The first is the most obvious yet the most powerful, the safe driver discount. Now you might be thinking, of course I'm a safe driver. But are you getting the maximum financial credit for it? This isn't just a tiny 5% nod for not having a ticket in the last year. A truly clean record, meaning 3 to 5 years with no accidents, no tickets, no claims, can unlock discounts of up to 40% with some carriers. 40%. That's a monumental saving for simply doing what you're supposed to be doing anyway. The insurance company sees you as pure profit. You pay your premium, you don't cost them any money, and in return they give you their best possible rate. It's a loyalty program where the reward is cold, hard cash back in your pocket every month. If you have a clean record and you're not seeing a good driver or accident-free discount explicitly listed on your policy, You need to make a call today. Right alongside that is the Good Student Discount. This is one of the most underutilized discounts in America because people misunderstand who it's for. This isn't just for the high school honor roll student. Most major insurers offer this for full-time students up to age 25, as long as they maintain a B average or a 3.0 GPA. If you have a young driver on your policy who's in college, this is a potential goldmine. We all know how astronomically expensive it is to insure a driver under 25. This single discount can often slash that youthful driver surcharge by 15 to 25%. Think about that. A 20-year-old on your policy might be costing you an extra $150 a month. A 25% discount on that alone is over $450 a year, just for sending in a copy of a report card. And here's a pro tip. Some insurers even offer a student away at school discount if your kid is attending college more than 100 miles from home and doesn't have a car with them on campus. They're still covered when they come home for breaks, but the insurer recognizes their driving risk is significantly lower for 9 months of the year. Combining the Good Student and the Student Away at School discounts is a 1-2 punch that can make insuring your college kid manageable instead of catastrophic. Okay, so those are the foundational layers. Now let's get to the really interesting stuff, the discounts that are tied to who you are and what you do for a living. These are the ones that require a little more digging, but the payoff is huge. Let's talk about your profession. Did you know that being a teacher, a firefighter, a police officer, an engineer, or a scientist could get you a cheaper car insurance rate? Insurers spend billions on data analysis, and their actuaries have found that people in certain professions tend to be more risk-averse. They file fewer claims, so they're rewarded with a low-risk occupation discount. It might not be a massive percentage, maybe 5 to 15%, but remember, we are stacking. This is another layer on top of your safe driver discount. If your insurer doesn't know you're an educator or a first responder, they're not going to give you the discount. You have to ask. And it goes even deeper. What about your affiliations? Are you a member of a college alumni association, a fraternity or sorority, a professional organization like the American Medical Association or the National Education Association? Are you a veteran or active duty military? All of these groups often have partnership agreements with major insurance carriers to offer their members exclusive group discounts. And one of the biggest ones people miss is warehouse club memberships. Places like Costco, Sam's Club, and BJ's have auto insurance programs for their members that can offer incredibly competitive rates, simply because they can negotiate on behalf of millions of customers. You're already paying for the membership to get cheap paper towels. You might as well see if it can save you hundreds on your car insurance too. Make a list of every group, club, and association you belong to. Then when you're getting quotes, ask the agent, do you offer a discount for members of insert group here? You'll be amazed at how often the answer is yes. But perhaps the single biggest lifestyle discount that has emerged in the last few years is the low mileage discount. The world has changed. Millions of Americans are now working from home, either full-time or in a hybrid model. Your commute might have gone from 20 miles each way to 20 steps from your bedroom to your home office. But did you tell your insurance company? When you first signed up for your policy, you estimated your annual mileage. If that number was, say, 12,000 miles a year, you were placed in a certain risk category. If you're now driving only 5,000 miles a year, you are in a completely different, much lower risk category. This isn't a small change. We're talking about a potential savings of 20 to 30% in some cases. It is one of the most direct correlations in insurance. The less you are on the road, the less likely you are to be in an accident. If your driving habits have changed significantly, you are overpaying, period. You are paying a premium for a risk you no longer represent. Now we move from you to the vehicle itself. Your car is likely already equipped with features that qualify you for discounts you might not even be aware of. Standard safety features like anti-lock brakes, daytime running lights, and multiple airbags can each shave a small percentage off your premium. But the big one here is an anti-theft device. If your car has a passive alarm system that arms itself automatically, or better yet, a vehicle recovery system like LoJack, you could be looking at a serious discount on the comprehensive portion of your policy. Insurers love these systems because theft is a huge source of claims. If your car is less likely to be stolen, and more likely to be recovered if it is, you represent less risk. Again, don't assume they know. You need to explicitly state what safety and anti-theft features your vehicle has. And that brings us to the final and perhaps most powerful discount in this entire category: telematics. This is the technology that powers programs like Progressive Snapshot or Allstate's DriveWise. It's the little plug-in device for your car, or the app on your phone that monitors your actual driving habits in real time. Now, I know what some of you are thinking. I don't want my insurance company tracking my every move. And that is a perfectly valid concern about privacy. But let's look at the numbers. For drivers who are genuinely safe, who don't speed, who don't slam on their brakes, who don't text and drive, and who don't drive late at night, the savings can be astronomical. We're not talking about 5 or 10%. We're talking about up to a 40% discount based on your real-world driving score. Think about it this way. Traditional insurance rates are based on demographics and statistics. They lump you in with other people your age in your zip code driving your kind of car. Telematics breaks that mold. It allows you to be judged on one thing and one thing only, your own driving. If you are a truly excellent driver stuck with a high premium because of your age or where you live, this is your golden ticket. This is your chance to prove to the insurance company that you are not a statistic. You are an individual, and you deserve a rate that reflects your actual, demonstrated safety on the road. It's a trade-off, yes. It's data for dollars. But if you're confident in your driving, it could be the single most impactful way to slash your bill. So picture it. You start with the base quote. Then you apply your 25% safe driver discount. You add the 15% good student discount for your son. You layer on the 10% discount for being an engineer. Another 5% for your alumni association. You get a 20% reduction for your new low mileage. And then you cap it all off with a 30% discount from the telematics program. These discounts don't just add up, they compound. They feed off each other, systematically dismantling that original, inflated quote until what's left is the leanest, most efficient premium possible. You've transformed a standard policy into a personalized contract that rewards you for every smart decision you make. This is the power of discount stacking. It's about taking control and making the system work for you, not against you. But what if I told you that all of these discounts, as powerful as they are still just one half of the equation? What if there's another, even more powerful lever you can pull, one that has nothing to do with your driving record, your car, or your job? There is a single 3-digit number that quietly dictates almost everything about the price you pay for insurance. And most people have no idea how profoundly it's affecting their rates. Understanding and optimizing this one number can be the difference between a good rate and an unbelievably great one. And that is the secret we're unlocking next. It's called your credit-based insurance score. And no, it's not the same thing as the FICO or Vantage score you see on your banking app. It's a cousin, a close relative, but it's been specifically engineered by the insurance industry for one purpose: to predict how likely you are to file a claim. Think about that. They believe that how you manage your money is a direct reflection of how you manage your risk behind the wheel. Now, before you get angry, and a lot of people do, let's step into their shoes for just 1 minute to understand the logic. Imagine two people, we'll call them Mark and David. Mark and David are identical in every way an insurance company can see on the surface. They're the same age, live in the same neighborhood, drive the exact same 2022 Honda Accord, and have spotless driving records. Not a single ticket or accident between them. Based on this, their insurance quotes should be identical, right? But then the insurance company pulls their credit-based insurance scores. They see that Mark has a long history of paying every bill on time. His credit card balances are low. He hasn't opened a dozen new accounts in the last year. He demonstrates financial stability and foresight. David, on the other hand, has a rockier history. He's missed a few credit card payments. He's maxed out a couple of his cards. He recently applied for a new store card, a car loan, and a personal loan all in the same month. His financial life from the outside looks a little chaotic, a little less planned. The insurance company's algorithm doesn't see Mark as a good person and David as a bad person. It sees data, and decades of data from millions of drivers have shown them a powerful correlation. People with financial profiles like Mark's file statistically fewer claims than people with profiles like David's. The theory is that the same sense of responsibility, the same long-term planning that leads to a great credit history, also leads to more responsible behavior in general. Things like getting your oil changed on time, replacing your bald tires, and not trying to beat a yellow light when you're running late. So the insurer offers Mark a rate of $150 a month. They offer David, his identical twin in every other respect, a rate of $275 a month. David is paying a staggering $1,500 more per year for the exact same coverage, all because of a number he probably didn't even know existed. This practice is so powerful and so controversial that several states have actually banned or severely limited its use. If you live in California, Hawaii, or Massachusetts, Insurers can't use your credit information to set your rates. Michigan has also passed laws to curb its influence. But for the vast majority of Americans in the other 46 states, your credit-based insurance score is one of the 3 most important factors in determining your premium, right up there with your driving record and your zip code. Ignoring it is like trying to win a boxing match with one hand tied behind your back. So how do you untie that hand? First, you need to understand what this score is actually made of. While the exact formulas are secret, they are heavily based on your standard credit report. They focus on 5 key areas. Number 1, payment history. This is the heavyweight champion. It accounts for the largest chunk of your score. Do you pay your bills on time every time? A single late payment that's more than 30 days past due can put a dent in your score that lasts for years. Number 2, credit utilization. This sounds complicated, but it's simple. It's the amount of credit you're using compared to the total amount you have available. Let's say you have one credit card with a $10,000 limit. If you have a $5,000 balance, your utilization is 50%. If you have a $1,000 balance, it's 10%. Insurers see high utilization, typically anything over 30%, as a sign of financial distress, which they equate with higher risk. Number 3, length of credit history. The longer you've successfully managed credit, the better. This shows a long track record of responsibility. This is why a 22-year-old with a perfect payment record will still have a lower score than a 52-year-old with the same perfect record. Time is on the 52-year-old's side. Number 4, new credit and inquiries. Every time you formally apply for a loan or a credit card, it generates a hard inquiry on your report. A single inquiry won't do much damage, but a flurry of them in a short period of time makes you look desperate for credit, which is a red flag for insurers. And number 5, credit mix. This is a smaller factor, but it still matters. Insurers like to see that you can responsibly manage different types of credit like a mortgage, a car loan, and a credit card, rather than just having 5 credit cards. Okay, that's the diagnosis. Now for the cure. How do you actively improve this score to unlock those massive discounts? It's not an overnight fix, but it's a straightforward process, and it starts today. Step 1 is to perform reconnaissance. You need to see what the insurance companies see. You are legally entitled to one free credit report from each of the 3 major bureaus, Equifax, Experian, and TransUnion, every single year. The only place you should go to get this is the official, government-mandated site, annualcreditreport.com. Don't go to the dozens of other sites that promise free reports but try to sign you up for a paid service. Go to the official source. Pull all 3 of your reports and go over them with a fine-tooth comb. Step 2, search and destroy errors. A Federal Trade Commission study found that 1 in 5 consumers had an error on at least one of their credit reports. That's 20%. This could be a late payment that wasn't actually late, an account that doesn't belong to you, or a debt that's already been paid off. If you find an error, dispute it immediately with the credit bureau. They are legally required to investigate. Getting a single negative error removed can cause your score to jump significantly, almost overnight. This is the fastest way to get a result. Step 3 is the most important habit you can build. Automate everything. Your mortgage, your car payment, your credit card bills, your student loans. Set up automatic payments for at least the minimum amount due on every single account. Life gets busy and it's easy to forget a due date by a day or 2. Automation makes on-time payments your default setting. It builds that flawless payment history, which is the very foundation of a great score. Step 4, go on a debt diet. Specifically, focus on your credit utilization. Look at all your credit cards and identify the ones with the highest utilization ratio. Even if the interest rate is low, a card that's at 90% of its limit is hurting your score more than a card at 20%. Your mission is to get every single card below that 30% utilization threshold. Pay down the highest utilization cards first. This will have the most immediate and positive impact on your score. Once you're below 30%, your next goal is to get below 10%, which is where you'll see the maximum benefit. And finally, step 5 is a bit counterintuitive. Don't close your old credit cards. Let's say you have a credit card you opened in college 10 years ago. You never use it and it has a 0 balance. Your first instinct might be to close the account to simplify your life. Don't do it. Closing that account erases a decade of your credit history. It shortens the average age of your accounts, which can actually lower your score. It also reduces your total available credit, which can increase your overall credit utilization ratio. So unless the card has an outrageous annual fee, just put it in a drawer and forget about it. Maybe use it once every 6 months for a small purchase to keep it active. By following these 5 steps, getting your report, disputing errors, automating payments, paying down balances, and keeping old accounts open, you are not just cleaning up your finances. You are systematically reverse engineering the insurance company's risk model. You are transforming yourself from their perspective of a high-risk David into a low-risk Mark. And the financial reward for doing that can be hundreds, if not thousands of dollars in savings every single year. This is a long-term strategy, a powerful one. But what if you need to save money right now? What if you're a fantastic driver, but your credit history needs a year or 2 to recover? Is there a way to prove it to them directly? A way to bypass the statistical models and just show them the raw, undeniable data of how safe you are on the road? The answer is yes. And it's probably already sitting in your pocket. It's your smartphone. It's the little supercomputer that you use to order a pizza, navigate to a new city, and watch videos just like this one. And it holds the key to fundamentally changing the way insurance companies see you. It allows you to move beyond being a demographic and become a data point of one. This technology is called telematics, or more commonly, usage-based insurance. The name sounds a little corporate, a little sterile, but the concept is revolutionary. For decades, insurance has been a game of educated guesses. They guess how you'll drive based on your age, your zip code, your credit score, and your driving record. But with telematics, the guessing game is over. Instead of predicting how you'll drive, they can just watch. Now, before you get a creepy Orwellian chill down your spine, let's break down what this actually means. It's not about a person in a control room watching your every turn. It's about an app on your phone, or sometimes a small device you plug into your car's diagnostic port, that passively collects data on your driving habits. It's a digital driving instructor sitting silently in your passenger seat, giving you a grade not on your parallel parking, but on the things that actually cause accidents. What exactly are they looking for? Surprisingly simple. They track a handful of key behaviors. First, hard braking. Are you constantly slamming on the brakes at the last second? Or do you maintain a safe following distance and slow down gradually? Second, rapid acceleration. Are you peeling out from every stoplight like you're in a drag race? Or are you smooth and controlled? Third, cornering. Are you taking turns at a safe, reasonable speed? They also look at the time of day you drive. Driving at 2 p.m. on a Tuesday is statistically way safer than driving at 2 a.m. on a Saturday, and your rate can reflect that. They track your total mileage. The less you drive, the less risk you represent. And finally, and this is a big one, many programs now track phone usage while the car is in motion. If you're someone who never texts and drives, this is your chance to get rewarded for it. Think about what this does. It shatters the old model. Let's go back to our 25-year-old driver with a perfect record. The insurance algorithm sees his age and his zip code and automatically flags him as a higher risk. It's not personal, it's just statistics. But with telematics, he can raise his hand and say, "Hold on. Don't look at the other 25-year-olds in my neighborhood. Look at me." The data from his phone can prove that he drives more like a cautious 45-year-old. He doesn't speed, he doesn't brake hard, and he drives mostly during the day. His personal real-world data can override the statistical stereotype, and his premium can drop dramatically. This isn't some niche experimental program. Nearly every major insurer in the United States offers a version of this. Progressive has Snapshot. State Farm has Drive Safe and Save. Allstate has DriveWise. Liberty Mutual has RightTrack. The names are different, but the core idea is the same. Prove you're a safe driver and we will give you a better price. So, how much better? The savings are real and they can be massive. Most companies will give you an immediate discount, often around 10%, just for signing up and trying the program. It's their way of encouraging you to participate. But that's just the appetizer. After a monitoring period, which is typically a few months or up to your first policy renewal, they analyze your data and calculate your personalized discount. For genuinely safe drivers, this can be anywhere from 20 to 40% off their premium. Let me repeat that. Up to 40%. If you're paying $2,000 a year for insurance, that's $800 back in your pocket. $800 not for switching to a worse plan with less coverage, but simply for being rewarded for the safe driving habits you already have. Let me tell you about a guy named Mark. Mark was a good driver and he knew it. He hadn't had a ticket in 7 years and never caused an accident. But he was getting hammered on his insurance rates. He lived in a dense urban area, and a few years back his credit took a temporary hit when he was between jobs. In the eyes of his insurance company, he was a walking red flag. Every 6 months, his renewal would come in the mail, and every 6 months, he'd feel that sense of hopeless frustration. He was being punished for things that had nothing to do with his actual ability behind the wheel. Then he heard about his insurer's telematics program. He was skeptical. They're going to track me? They'll know I went to the grocery store and then to my friend's house. The privacy aspect worried him, but then he looked at his bill again and decided to at least look into it. He read the fine print. The company was very clear. The data was used for rating his driving and for research in an aggregated, anonymous form. They weren't interested in his destination. They were interested in the journey. Did he speed? Did he slam on the brakes? He decided to give it a shot. He downloaded the app, went through the setup, and then just drove. For the first few days, he was hyper-aware of it. He drove like he was taking his driving test all over again. But after a week, he forgot it was even there. He just drove like he normally did, which, as it turned out, was pretty safely. The app gave him feedback. A little summary after each trip. Great job on smooth braking. Or, 98% of your trip was without distraction. It was almost like a game, and he found himself checking his score, feeling a little bit of pride in his consistently high marks. 3 months later, an email landed in his inbox. It was his updated insurance quote based on his driving data. He braced himself and opened it. He had to read it twice. His 6-month premium had dropped by 32%. Over the course of a year, that was a savings of more than $600. For the first time, he felt like he had some control. He wasn't just a number in an algorithm based on his address and his past. He was Mark, the guy who doesn't tailgate and who keeps his phone in his pocket. The data proved it. The savings confirmed it. Now let's address the big questions you're probably thinking, the same ones Mark had. First, privacy. Yes, you are sharing data. There's no way around that. But you need to ask yourself what that data is and how it's being used. In most cases, it's anonymized and used to refine their risk models. They aren't selling your minute-by-minute location to marketing companies. Every program has a detailed privacy policy, and you should absolutely read it. But in a world where our phones already track our location for maps, for social media check-ins, for weather alerts, is letting it track your braking habits for a potential 40% discount really that much of a stretch? Second, the big fear. Can my rates go up if the app decides I'm a bad driver? This is a critical question, and the answer is, it depends. This is where you have to do your homework. Many, if not most, of the largest programs in the country are structured as discount only. This means the best you can do is get a huge discount, and the worst you can do is get no discount at all. Your rates won't increase based on the telematics data. However, some smaller companies or programs in certain states can use the data to apply a surcharge for very risky driving. The key is to ask. When you call your agent or the company, ask this question directly. Is this a discount-only program, or can my premium increase based on the data? Get a clear answer before you agree to anything. And what about mistakes? What if you have to slam on the brakes to avoid a deer? Or a kid who runs into the street? Will that one event tank your score? The answer is almost always no. These systems are designed to look for patterns, not single events. They analyze thousands of data points over months of driving. 1 or 2 heartbreaking incidents over a 6-month period won't even register. They are looking for the habit of heartbreaking, the pattern of risky behavior. The system is smart enough to know the difference between an emergency maneuver and a dangerous driving style. So how do you get started? It's simple. Pick up the phone and call your current insurance provider. Ask them by name. Do you have a usage-based or telematics program like Snapshot or DriveWise? If they do, ask about the potential discount range and whether it's a discount-only program. If you're shopping for new insurance, make this one of your primary questions for every quote you get. And here's a pro tip. Some companies, like Progressive, will even let you do a test drive of their app before you become a customer. You can download the app, let it track your driving for 30 days, and it will show you the discount you would qualify for if you switched. It is a completely risk-free way to see if your driving habits are as good as you think they are, and to quantify the exact amount of money you're leaving on the table. By embracing this technology, you're changing the very nature of your relationship with your insurer. You're turning an adversarial system based on suspicion and statistics into a collaborative partnership based on trust and transparent data. You're giving them a window into your real-world behavior, and in exchange they're giving you a premium that reflects you, the individual, not the demographic you happen to belong to. So you've now proven you're a safe driver with telematics, and your rates are down. But what if the very car you're driving is secretly costing you a fortune in insurance? no matter how safely you handle it. Some of the most popular best-selling cars in America are also the most expensive to insure, for reasons you'd never ever expect. And the answer why is hidden in plain sight, on a boring government website that could save you thousands. That website is the National Highway Traffic Safety Administration, or NHTSA. And buried in its databases is a list that insurance companies know by heart. It's the list of the most frequently stolen vehicles in America. And if your car is on that list, you're already paying a penalty, even if you live in the safest town in the country. This brings us to the third and arguably most impactful way to find cheaper insurance: choosing the right car from the very beginning. Now this sounds obvious, right? Don't buy a Ferrari and expect to pay the same as you would for a 10-year-old Corolla. But that's not what I'm talking about. I'm talking about the hidden insurance traps baked into the most common, most sensible, most popular cars on the road. Let's take the Honda Accord. For decades, it's been the poster child of responsible car ownership. It's reliable, safe, and fuel efficient. It's the car you buy when you've decided to make smart financial decisions. So you buy a brand new Accord, you call your insurance agent, beaming with pride about your sensible purchase, and they hit you with a quote that makes your jaw drop. It's hundreds of dollars more per year than you were expecting. What gives? You didn't buy a sports car. You bought an Accord. Here's what the insurance company knows that most buyers don't. The Honda Accord, along with its sibling the Honda Civic, is consistently one of the most stolen cars in the United States. Not by joyriders looking for a thrill, but by sophisticated theft rings for one simple reason: parts. Because there are millions of Accords on the road, there is a massive thriving black market for their parts. Fenders, airbags, catalytic converters, headlights, you name it. A stolen Accord can be stripped down and its parts sold for far more than the value of the car itself. Every time one is stolen, an insurance company has to pay out a massive claim. They track this data meticulously. They know down to the decimal point the probability of an Accord in your zip code being stolen compared to, say, a Volvo S60. That risk is priced directly into your premium. It doesn't matter if you have a top-of-the-line alarm system and park in a locked garage. You are subsidizing the cost of all the other Accords that get stolen. The same exact logic applies to the best-selling vehicles in the country, the Ford F-150 and the Chevy Silverado. Their popularity is their curse when it comes to insurance rates. But theft is only the first layer of the problem. The second, and increasingly expensive layer, is the cost of repairs. Think about a simple fender bender from 15 years ago. You'd need a new bumper, maybe a new headlight and some paint. A body shop could fix it for a reasonable price. Now let's look at that same fender bender in a modern car, even a non-luxury one like a Toyota Camry. That plastic bumper cover you see isn't just plastic. It's hiding a suite of advanced technology. Behind it are radar sensors for adaptive cruise control, ultrasonic sensors for parking assist, and sometimes even cameras. A minor impact that barely leaves a scratch can knock these sensors out of alignment or damage them. The bumper itself might cost a few $100s, but the sensor behind it could be over $1,000. And after it's replaced, the entire system needs to be recalibrated by a technician with specialized, expensive equipment, costing hundreds more. That simple side view mirror that got clipped in the parking lot? It's not just a piece of glass anymore. It has a heating element, a motor to adjust it, a blind spot monitoring warning light, and sometimes a camera for the 360-degree view system. A part that used to cost $50 can now easily be a $1,000 repair. A cracked windshield? If your car has a lane-keeping assist system, there's a camera mounted behind that glass. Replacing the windshield now requires a multi-hour recalibration process to ensure the safety system works correctly. Insurance companies aren't guessing about these costs. They have mountains of data from millions of claims. They know the average repair cost for a front-end collision on a 2023 Honda CR-V versus a 2023 Subaru Forester. If one car is loaded with more expensive-to-replace tech in its bumpers, its insurance premium will be higher. Period. This leads to a really counterintuitive truth about safety ratings. We're all trained to look for those 5-star government crash test ratings. And you absolutely should. A car that protects you and your family in a crash is priceless. But there's a difference between occupant safety and vehicle damage. A car can be engineered to be incredibly safe for you by having crumple zones that brilliantly absorb the force of an impact. The car essentially sacrifices itself to save you. This is a good thing. But for an insurance company, it means a 25-mile-per-hour collision that you walk away from without a scratch might result in a bent frame and a car that's declared a total loss. A total loss is the most expensive possible claim for an insurer. So, paradoxically, some of the safest cars for humans can be the most fragile, and therefore most expensive for insurance companies to cover. So what's the smart play here? It's to do your insurance homework before you even think about test driving. The secret is to look for the good but unpopular cars. Instead of the Honda Accord, get an insurance quote for a Mazda 6. Instead of the Toyota RAV4, check the rates on a Subaru Forester or even a Buick Envision. These are often fantastic, reliable, safe vehicles that just don't sell in the same astronomical numbers. Because they are less common, there's a smaller black market for their parts, making them less of a target for theft. Their repair costs might be lower, or they may just have a better claims history. This is where you can find a massive edge. Before you fall in love with a car on the lot, make a short list of 3 or 4 models you're considering. Then call your insurance agent or use an online portal and get a real quote for each one. Don't just guess. The difference can be staggering. You might find that the car that's $5,000 cheaper to buy actually costs $800 more per year to insure. Over 5 years, that cheaper car just cost you $4,000 extra, wiping out most of the savings. You need to shop for the total cost of ownership, not just the sticker price. The Insurance Institute for Highway Safety, or IIHS, even publishes this data. You can go on their website and look up the insurance loss data for almost any car model. It's broken down by collision, comprehensive, and injury claims, and it's rated as better than average, average, or worse than average. It is a literal cheat sheet that tells you which cars are costing insurance companies the most money. If you choose a car with better than average losses across the board, you are almost guaranteed a lower premium. Choosing the right car is a strategic move that pays dividends for as long as you own it. It's about understanding that your car is seen by an insurer as a bundle of risks: the risk of theft, the risk of expensive repairs, the risk of being easily totaled. By choosing a car with a lower risk profile, you're taking direct control of one of the biggest factors in your insurance rate. But the car you drive is only one part of the equation. We've covered discounts and vehicle choice, but now we need to talk about you. Not your driving record, we all know that matters. I'm talking about a single 3-digit number that has absolutely nothing to do with how you drive, yet it can have a bigger impact on your insurance premium than a speeding ticket and an at-fault accident combined. It's a secret pricing factor that many people feel is deeply unfair, but knowing how it works is the key to turning a major liability into your greatest advantage. And we're going to break down exactly what it is and how to master it right after this. Alright, let's talk about the ghost in the machine. The invisible number that follows you everywhere, dictating the price you pay for almost everything from a mortgage to, yes, your car insurance. This secret factor, used in almost every state except California, Hawaii, and Massachusetts, is your credit-based insurance score. Now hold on. Before you click away thinking, this is just about my credit score, I already know this. I promise you it's not that simple. And the way insurance companies use it is far more nuanced and frankly far more important than you've been led to believe. This isn't your FICO score. It's a completely different beast, calculated with a different formula for a different purpose. And understanding that difference is like being handed the keys to the kingdom. So why do they do this? Why does your ability to manage a credit card have anything to do with your ability to navigate a 4-way stop? The insurance industry's answer is cold, hard data. Over decades, they've run the numbers on millions of drivers and found a powerful statistical correlation. People who are more responsible with their finances also tend to be more responsible behind the wheel. They file fewer claims, they're involved in fewer accidents, and they're statistically a safer bet. Is it fair? That's a huge debate. Many people argue it's deeply unfair, that a medical bill you're struggling to pay or a student loan from 10 years ago shouldn't penalize your driving record. And honestly, that's a valid point. But for now, in most of America, this is the reality of the game. Our job isn't to debate the rules. It's to learn how to win. So let's turn this liability into your secret weapon. First, you have to understand what this score actually cares about. Unlike a FICO score, which is trying to predict if you'll pay back a loan, an insurance score is trying to predict if you're likely to file a claim. Because of that, it weighs certain factors much more heavily. And the undisputed king, the most important factor by a mile, is your payment history. A single late payment, just one, can be a cannonball to your insurance score. It signals a lack of financial stability, which in their algorithm, translates to higher risk. The single most powerful thing you can do starting today is to put every single one of your bills on autopay. Your credit cards, your utilities, your phone bill. Never ever be late again. It's the foundation upon which everything else is built. But the second factor is where the real magic happens. This is where you can see dramatic improvements in a very short amount of time. It's called your credit utilization ratio. Sounds complicated, but it's simple. It's just the amount of credit card debt you have compared to your total credit limit. Let's imagine a driver, we'll call her Sarah. Sarah is a great driver. No accidents, no tickets. But she had a major home repair last year and had to put $5,000 on a credit card that has a $10,000 limit. Her credit utilization is 50%. Now let's imagine another driver, Mark. Mark has the exact same $10,000 credit limit, but he only has a $500 balance. His utilization is just 5%. Even if Sarah and Mark have identical driving records, the insurance company's algorithm sees Sarah as a much bigger risk. A 50% utilization ratio flashes a warning light that says, financial stress. And financial stress to an insurer correlates with a higher likelihood of filing a claim, maybe putting off car maintenance, maybe driving more recklessly due to stress, or maybe just being more likely to file a small claim they might otherwise pay out of pocket. Mark, with his 5% utilization, looks stable and low risk. He will almost certainly be offered a lower premium. The general rule of thumb you always hear is to keep your utilization below 30%. And that's good advice. But if you want to be in the absolute top tier, the A+ group that gets the best possible rates, you want to aim for under 10%. So, how do you do that, especially if you're carrying a balance like Sarah? This is the part they don't tell you. This is the hack that separates the amateurs from the pros. Most people think the credit card companies report your balance to the credit bureaus on your payment due date. That is wrong. They report the balance that is on your monthly statement on the day the statement closes. This is a critical distinction. Let's go back to Sarah. Her statement closes on the 15th of the month, and her payment is due on the 10th of the following month. Like most people, she waits until the 8th or 9th to pay her bill. But by then, the credit card company has already sent the report to the credit bureaus with her $5,000 balance, locking in that high 50% utilization for the entire month. Here's the power move. Find out your statement closing date for every credit card you have. You can find it on your statement or by calling the company. Then, make a large payment a few days before that closing date. If Sarah takes $2,000 from her savings and pays down her card on the 12th, before the statement closes on the 15th, her reported balance will suddenly drop from $5,000 to $3,000. Her utilization for the month plummets from 50% to 30%. Instantly. If she can get it down to under $1,000 before the closing date, she moves into that elite under 10% category. You can literally manipulate your credit utilization month to month with this strategy. If you know you're going to be shopping for car insurance in the next 60 days, you make it a priority to pay your balances down right before the statement closing dates for 2 cycles. The impact on your insurance score will be immediate and profound. This single tactic can save you hundreds of dollars a year. Finally, a quick but crucial piece of advice that seems completely backwards. Do not close old and used credit cards. You might think closing an old account you never use is a responsible move. It's not. Closing an old card does 2 very bad things to your score. First, it reduces your total available credit. If you have $20,000 in total credit limits across 3 cards, and you close one with a $10,000 limit, your total credit limit is cut in half. Now, any balance you carry will double your utilization ratio instantly. Second, it can shorten the average age of your credit history, another key factor in your score. A long, stable credit history is a sign of reliability. So take that old card you never use, put a small recurring charge on it like a Netflix subscription, set it to autopay, and let it sit there quietly boosting your score forever. By focusing on these 3 pillars, perfect payment history, mastering your utilization by paying before the statement date, and keeping old accounts open, you are directly manipulating the very formula used to calculate your insurance premium. You're taking control away from the black box algorithm and putting it back in your hands. It's not about being a perfect driver anymore. It's about being a smart financial operator. You can have the cleanest driving record in the world, but if your credit-based insurance score is in the gutter, you will pay a penalty. Conversely, you can have a minor fender bender on your record, but if your insurance score is excellent, you will soften the blow dramatically. Now that you know how to fix the invisible factors that are quietly driving up your costs, there's one final massive mistake that 90% of people make. It happens at the very last second, right when you're about to buy the policy. It's a psychological trap that insurance companies have perfected, and falling for it can erase all the hard work you've just done, costing you thousands over the life of your policy. and I'm going to show you exactly what it is and how to sidestep it like a pro. It's a trap baited with your own exhaustion. After hours of research, filling out forms, and comparing numbers, you've finally found it. The winning quote. It's hundreds of dollars cheaper than your current policy. All that's left is to make the final call and purchase it. You're tired, you're relieved, and you're ready to be done. And that is the exact moment they've been waiting for. This is when the friendly, helpful agent on the other end of the line becomes one of the most skilled salespeople you'll ever encounter. Their job, in that single phone call, is to claw back as much of that savings as they possibly can, using a finely tuned script of psychological triggers. The first weapon they'll deploy is the upsell, disguised as genuine concern. You'll say, "Hi, I'm ready to purchase quote number 12345. And they'll reply, "Excellent choice. I'm just pulling that up now. As I'm looking over this, I see you've selected the state minimum for liability. I have to be honest, in today's world, that's like trying to stop a tidal wave with a paper towel. We had a client last month, a really careful driver, got into a minor fender bender that turned into a $500,000 lawsuit. For just $12 more a month, we can triple your coverage and give you real peace of mind." Do you see what just happened? They created a vivid, terrifying story. They used scarcity and fear. They anchored the solution to a seemingly tiny number, just $12 a month, without ever mentioning that it adds up to $144 a year, potentially wiping out a huge chunk of the savings you just fought for. The defense against this is simple, but it requires discipline. You must go back to the work you did in the beginning, where you determine the exact coverage you need. Your line is straightforward and non-negotiable. "Thank you for the information, but I've already assessed my risk tolerance and I'm comfortable with the coverages I selected. Can we please proceed with the original quote?" You don't need to justify or explain. You are the customer. You are in control. Repeat it as many times as necessary. The next tactic is the bundle ambush. This is especially common if you're switching to a company that also offers home or renter's insurance. The agent will say, "Oh, and I see you have a home address here in Ohio. I can see you're not currently bundling your home insurance with us. Did you know that if we bundle them together, you'll unlock an additional 20% discount on your auto policy? It's a fantastic deal." On the surface, this sounds amazing. A 20% discount. But this is a mathematical shell game. They're banking on you being so seduced by the auto discount that you don't ask the critical question. What is the price of their home insurance? Often, their home insurance policy, even with the discount, is significantly more expensive than what you could get from a competitor. You might save $150 on your car insurance but end up overpaying by $400 on your home insurance for a net loss of $250. You've been played. The countermove is to slow the game down. You say, "That's very interesting. I'm definitely open to that. Could you please email me a formal itemized quote for the home insurance policy, including all the coverage details and the final bundled price? I'll need to compare it to my current policy. For today, let's just finalize the auto insurance we've already discussed." This does two things. It gets you off the phone without being pressured, and it forces them to put their numbers in writing, where you can analyze them without a salesperson whispering in your ear. 9 times out of 10, sticking with the best-in-class provider for each individual policy is cheaper than the so-called convenience of a bundle. But the most powerful trap, the one that costs Americans billions of dollars, is the loyalty penalty. This happens when you call your current insurance company to tell them you're leaving. You see, your existing insurer knows you. They know your payment history, they know your driving habits, and most importantly, they know that humans are creatures of habit who hate change. The department you'll be transferred to isn't called cancellations. It's called retention, and it's staffed by their most experienced agents. Their job is to retain you at the highest possible price. You'll say, "Hi, I need to cancel my policy. I found a better rate elsewhere." The retention specialist will then put on a masterclass. They'll say, "Oh wow, I'm so sorry to hear that. I see you've been a loyal customer with us for 8 years. We value that loyalty so much. We really don't want to see you go. Let me ask, what kind of rate did they offer you?" You'll tell them your new lower quote. They'll type for a few seconds and come back with the checkmate move. "Okay, I see. Look, because you've been with us for so long, I've been authorized to apply a special loyalty discount. It looks like I can get your premium down to just $5 more a month than the new company. It's not quite a perfect match, but for just $5, you get to avoid the hassle of switching everything over, and you get to stay with a company you know and trust. How does that sound?" This is brilliant and it is devastatingly effective. They've conceded a little, making you feel like you've won. They've minimized the difference to an insignificant sounding $5. And they've leveraged your natural aversion to change and hassle. Most people cave right here. They say, okay, that sounds fair. And they lose. They just agreed to pay $60 a year extra for the rest of their lives out of pure inertia. They snatch defeat from the jaws of victory. To defeat this, you need to have one final powerful tool in your arsenal. I call it the price match gambit, but you don't use it on your old company. You use it on your new one. Let me explain. Let's say you've done your research. You have a quote from Progressive for $900 a year. It's the cheapest. You also have a quote from Geico for $950 a year. You actually like Geico a little better. Maybe their app is better or their customer service reviews are stronger. Before you call Progressive to buy, you call Geico. And you say this word for word. Hi, I have a quote from you for $950 for the year. I'd really prefer to sign up with you guys, but I have a competing offer from Progressive for the exact same coverage for $900. I know this is a long shot, but is there any way you can match that price to earn my business? Then you stay silent. What happens next feels like magic, but it's pure business. The insurance industry is brutally competitive. Companies spend a fortune, sometimes over $500, in marketing and advertising just to acquire a single new customer. The agent on the phone knows this. They know that they are one tiny step away from closing a deal and hitting their quota. Losing you over a mere $50 is a terrible business decision for them. More often than you'd think, the agent will say, let me check something. I see there's one more discount we might be able to apply here. It's an e-signature discount. Yes, it looks like if you agree to sign your documents online today, I can take another $50 off the policy. That brings you right to $900. Would you like me to set that up for you? Boom. You just got the company you wanted at the price of their cheapest competitor. You leveraged their customer acquisition cost against them. This single 5-minute phone call can save you hundreds of dollars over the next few years. And it gives you the ultimate, rock-solid position. Now, when you call your old company to cancel and their retention specialist offers to get close to your new rate, you can confidently and politely say, I appreciate that, but I've already been given a locked-in rate of $900 and I've already decided to switch. Please proceed with the cancellation. There is no countermove. You have won the game. By preparing for this final conversation, by understanding the psychological tricks they use, and by having a concrete playbook, you transform from a passive price taker into an active, empowered negotiator. You ensure that every single dollar you worked so hard to save actually ends up back in your pocket. But locking in this incredible new rate is only half the battle. The war for your wallet is never truly over. In fact, the single biggest and most costly mistake that nearly everyone makes happens in the 12 months after they've signed their new, cheaper policy. It's a silent, automatic process that can completely erase all of your hard-won savings and put you right back where you started, or even worse. And in the final part of this guide, I'm going to reveal what this mistake is, and give you a simple 2-minute annual strategy to make sure you never fall for it again. The single biggest, most expensive mistake you can make after finding a great insurance deal is this: doing absolutely nothing. It's the mistake of misplaced loyalty. We are taught our whole lives that loyalty is a virtue, that it should be rewarded, and in many parts of life it is. But in the modern car insurance industry, loyalty is often treated as a vulnerability to be exploited. It's a harsh truth, but understanding it is the final key to unlocking a lifetime of savings. This phenomenon has a name. Some call it price optimization. Others call it the loyalty tax. It's the silent, creeping increase in your premium, year after year, renewal after renewal. It's not a huge, shocking jump that makes you immediately pick up the phone. It's far more insidious than that. It might be an extra $6 a month this time, then an extra $8 a month 6 months later. It's so small you barely notice it. You might chalk it up to inflation or some new state regulation. You think, well, it's just a few bucks. It's not worth the hassle of shopping around all over again. And that is exactly what they are counting on. Think about it from their perspective. The insurance companies spend a fortune on advertising to get you in the door. They offer incredibly competitive, low introductory rates to lure you away from their competitors. They win your business. But once you're a customer, the calculation changes. They know that the vast majority of people are busy. They know that shopping for insurance is a chore most people want to do once and then forget about. They know that once you're set up with autopay, you're statistically very unlikely to leave, unless you have a major price shock or a bad claims experience. So they begin to test the waters. They nudge your premium up at your next renewal. Did you complain? Did you leave? No? Great. At the next renewal, they'll nudge it up again, maybe a little more this time. They are slowly, methodically walking your rate up from that amazing introductory price to the maximum price they believe you're willing to pay without leaving. It's like a leaky faucet dripping away your money one tiny, almost imperceptible drop at a time. But over 2, 3, or 5 years, those drips add up to a flood of wasted cash, hundreds, sometimes even thousands of dollars that you've paid for the simple crime of being a loyal customer. Your loyalty, instead of being rewarded with a discount, is being punished with a tax. Meanwhile, that same company is offering brand new customers a rate that's significantly lower than what you, their customer of 5 years, are now paying. They are using the extra money you're paying, the loyalty tax, to subsidize the low rates they need to attract new business. Feels like a betrayal because it is. You've been a perfect customer. You've paid on time, you haven't had any accidents, and your reward is to unknowingly pay more than you should. This is the trap that erases all your hard work. You can follow every tip we've discussed, bundle your policies, raise your deductible, clean up your driving record. But if you then sit back and let the loyalty tax kick in, you'll watch those savings evaporate over time, putting you right back where you started. But now that you know the game, you can refuse to play. You can turn their own strategy against them. And you do it with a simple, powerful 2-minute annual strategy that will keep you in the driver's seat for good. Here's what you're going to do. Right now, not later, I want you to pull out your phone and open your calendar. Find the date your car insurance policy is set to renew. Now go back exactly 1 month from that date and create an annual recurring event. Title it, Shop for Car Insurance. That's it. That's the first step. By putting it on your calendar as a recurring event, you are automating your savings. You're turning a chore you might forget into a non-negotiable financial checkup. When that calendar reminder pops up a month before your renewal, you're going to execute the 2-minute drill. You'll take the declaration page from your current policy, which lists all your coverages and limits, and you'll go to one of the online comparison tools we talked about earlier. You already know your information, you know what coverages you need. You can fly through the forms in minutes, and in less time than it takes to brew a pot of coffee, you will have a crystal clear snapshot of the current market. You'll have multiple quotes from competing companies for the exact same coverage you have now. This is your moment of truth. You now have leverage. You have information, and in this game, information is power. You have 2 paths forward. If you find a quote from another A-rated, reputable insurance company that is significantly cheaper, we're talking $100 or more in savings, then it's often time to make the switch. The process is easier than ever before. You can buy the new policy online, and your new insurer will often even help handle the cancellation of your old one. Don't feel bad about leaving. This isn't a personal relationship. It's a business transaction. You are simply choosing the vendor that provides the best value. But there's also a second very powerful path. Let's say you like your current company. You've had good service and you'd rather not switch. Now you can make the call. You phone your insurer's customer service line and you say something very calm and very simple. Hello, my policy is up for renewal next month. I've been a loyal customer for 5 years now with a perfect driving record. I've just done my annual due diligence and received a quote from another company for the exact same coverage for $200 less per year. I'd really prefer to stay with you, so I'm calling to see if you can match that price to keep my business. And then you are silent. You let them respond. You have just respectfully and professionally put them on the spot. You've shown them you're a savvy consumer, not one who will blindly accept their price creep. You'd be absolutely shocked how often this works. The customer service agent will often put you on hold, tap a few keys, and come back with a new lower rate. They might not match the competing offer exactly, but they will often come down significantly, instantly saving you money for a 5-minute phone call. They have special retention discounts they can apply, but they only give them to the people who ask. By making that one call, you've proven you're one of those people. This 2-minute annual checkup is the ultimate defense. It ensures that you are never ever paying the loyalty tax. It keeps your current insurer honest, and it guarantees that you always have the most competitive rate the market can offer. So let's bring it all home. We've covered the 5 smartest ways to get cheaper car insurance in America. First, we learned to stop overpaying for coverage we don't need by truly understanding our policy and making strategic adjustments to our deductibles and limits. Second, we uncovered the power of stacking discounts, from bundling home and auto to leveraging every possible affinity group. good student, and safe driver program available. Third, we focused on what we can control, improving our driver profile. We talked about how a better credit score and a clean driving record are long-term investments that pay massive dividends in lower premiums. Fourth, we learned how to shop smarter, not harder, by using independent agents and online comparison tools to make the entire market compete for our business in minutes. And finally, and most importantly, we've unmasked the loyalty tax and created a permanent, automated strategy to ensure we never fall victim to it, keeping our rates low not just for 1 year, but for every year to come. The world of car insurance is designed to be confusing. It's designed to make you feel like the price is out of your control. But it's not. With the knowledge you now have, you are in complete control. You have the playbook. You know how the game is played and you know how to win. So please don't just watch this video. Use it. Set that calendar reminder right now. The next time you see a car insurance ad on TV, you won't just see a talking gecko or a funny commercial. You'll see a multi-billion-dollar industry that you now know how to navigate like a pro. If this guide has helped you, if it's given you even one idea that will save you money, do me a small favor and hit that like button and subscribe for more deep dives on how to master your money. It's the best way to tell the algorithm that this was valuable information that more people should see. And for everyone watching, I want you to share your success. Let me know in the comments the single biggest saving you've ever made by switching or renegotiating your car insurance. Let's show everyone what's possible. Thank you for your time and attention. Drive safe and save smart.